All right, the S&P rally for its 8th straight day to the upside today. 17th day out of the past 20. We're going on a stretch of 18 out of 20 days. 20 days being a 4-week range. To go up all but 2 in 4 weeks is quite the significant rally. Like one we haven't seen since I think I saw 1971 was the last time we were 17 out of 19. So very, very strong moves. Lots of extremes in some indicators, some divergences setting up in others. We'll talk about, I'll show you what those patterns look like, what to expect, how far up above some of these moving averages we are, what significance that has in terms of when we can expect, not even for the markets to drop, which I think everyone either expects the markets to go up or to go down significantly, but for the markets just to start to grind. We may have started to see the first day of that today, the kind of day we expect we'll see a lot more of over the next week or two. Slow, small range, low volume moves to the upside. So we'll break that down, kind of the expectations for that and what that means. And then our trade idea of the day is a stock that's starting its own intermediate trend, not to the same degree as what the S&P 500 is, but has its own good bullish pattern. We'll talk about how to trade that going into its own earnings tomorrow morning. So let's go ahead and get started. Today is Monday, November the 8th, 2021. This is the market outlook from marketscholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. We've had our now 1, 2, 3, 4, 5, 6, 7, 8th day in a row to the upside, and however many, 17 out of 19 days now that we've had to the upside. Again, this entire near-term run since the one little dip below 50, but not quite in the bearish territory. Otherwise, one big long near-term rally here spanning pretty much the whole 19 days. The momentum line dropped as we got smaller ranges, but not to an extreme. The near-term line dropped because of, again, the smaller ranges and smaller gains and not closing it near the highs. But again, dropped to just barely out of the upper reversal zone. So it's actually still in bullish territory. We still have the intermediate line well above 90. In fact, it's above 95. It's close to the 98th percentile. So about as strongly bullish as you could possibly be. Market sentiment, interestingly enough, as strongly bullish as we've been, market sentiment hasn't really been rising. Now, granted, it should start taking off here pretty soon, but I mean, that's a pretty flat market sentiment line for pretty much the entire near-term rally. I mean, once we got above 80, we got above 90, and we pretty much have stayed above 90. And as I mentioned before, in some of our market scholars classes, these are pretty rare to get the near-term line above 90 for 5 days in a row, and we've got it twice in the same near-term run. So it's one thing to get it at all, much less back-to-back within the same rally. So very strong move, of course. We're nearly 5% above the 30-day moving average. That's in the 97th percentile of the past year in terms of how bullish we've been. That's as far above the 30-day moving average as we've been there. If you take a look at the Dow Jones Industrial Average, we have a very similar looking chart, almost exactly the same. If you take a look at the NASDAQ 100, also looks almost exactly the same. The momentum line dropped to a smaller level, but again, I mean, you look at the gains, and I mean, it was a down day for the NASDAQ, but very, very small range. The market sentiment line just sitting at the bottom of bullish territory, very flat. The Russell 2000 also has a very strong gain. Also, nearly 7% up above its 30-day moving average. Very strong intermediate posture, momentum line in bearish territory, near-term line still in bullish territory despite the rally, despite the small gain today, despite its pullback. And you see that it didn't stay above 90 for very long. Here's the 90th percentile. It only spent 3 days above 90 before pulling back down. But still, still in the upper reversal zone, still very bullish. And market sentiment line rising after being flat for months. Now appears that we are trying to break out here. So market forecast showing bullish patterns all across the board. Dark green shading, green line, about as bullish as you can be here. Let's take a look at the weekly chart. with the Hakinyashi candles, and you can see again, last week we closed above the prior week's high, closed well above that. So far, we're not quite there to this week. Again, it's only one day, so take that for what it's worth. But we'll kind of watch to see if we can close up above that 47.18. Remember, the Hakinyashi close is different than the regular close, because right now we're trading actually at 47.01. The Hakinyashi closed at 47.03. So kind of keep an eye on where we're closing relative to the Hakinyashi close to kind of get into sense of how strongly bullish we are. The candle's already getting smaller. You can see the bullish candle starting to move down a little bit there. Obviously we're well above the 10-week exponential, so not in any danger anytime soon at all of any kind of pullback. When you look at the 3 green arrows, you can see the histogram had turned green. It's turned back over now, and we're kind of fading. You can see that. Not quite there on the diamond, but we are fading back down on the Qs, and we're not quite fading yet on IWM. When you look at these two indicators, with 3 green arrows here, so we have, green shading in the background of all these major indexes. When you look at the 2-line version of the MACD and stochastics, you can see again the MACD still hasn't peaked. So we haven't even, we still haven't started our bullish convergence. The 30-day moving average just barely starting to cross up above the 50 after being below it for a smidgen of time. And of course, well up above the strong volume node that's below us here. So remember, when you start to converge, when you converge here, when the blue line crosses below the orange, you can see a couple of good examples here from high MACD levels. You still trend higher during the bullish convergence. You still trend higher there. We don't go at the same pace, but you're still bullish until if and when the MACD crosses below 0. Usually it coincides with the price crossing below the 30-day moving average, and you get some kind of some type of a pullback at that point. So we're still not to that stage. You can see whether it's on SPY, the Qs, IWM, all their MACDs are still all rising to these really strong levels and haven't peaked yet. And then again, once they do peak, you still expect that we'll still converge and stay above the 8 and maybe break the 8, but still stay above the 17 until you start to get more of a bearish divergence where you break the 17 and stay below it, and then start more of some kind of intermediate pullback at that point. So again, nowhere close to that right now. So take a look at some of these other oscillators here. Again, we've talked about how extreme we are with the DMI, and you can see the ADX getting to the highest level of the past year on SPY. IWM, you can see the positive indicator is up above 40 again. QQQ, same thing, and the negative indicator is down to 10. So very extreme, the highest ADX on the Qs all year long. So the very, very extreme levels there. You can see when you look at the RSI, we got the big time RSI. Like the RSI is at the highest level it's been in a long, long time. Again, just goes to show just how strongly bullish we are. The last time we got this bullish was going into that September peak. You can see we also got strongly bullish going into that June peak where we kind of went parabolic. We also diverged going into the COVID low when we had that divergent high point. And you can see another peak right there up above 70 where we started that May decline. And then of course in 2017 and in the beginning of 18 we were extremely high, and you can see the big divergence that we're setting up on the CCI right now with the extreme high point on the RSI. If we take a look at the Bollinger Bands, obviously we're still in the upper quartile. The bandwidth appears to have peaked, and the blue line's rising, the orange line's still rising, so they haven't started to come together yet. That's when that bandwidth will start to fall. It kind of would be kind of similar to a bullish convergence. Obviously, we're not going to cross below that midpoint here anytime soon. You see that as well in the Ichimoku trend cloud, well above 5, well above 80. So very strong trend, well above the cloud, well above the green and the blue lines. So nowhere near bullish trend. Even IWM has finally not only started a trend, because we haven't had a trend going at all, a little bit of a bearish one there. But this is we haven't had a trend for so long. Now not only do we have a trend, but we're also above 5 and above 80. So we have a very strong extreme trend going right now, which again is very hard to break without some type of catalyst. A lot of times I show you like that Arun indicator. I haven't brought that up here, but just to kind of give you an idea. Again, until that red line spikes up to 100, we don't have any concerns here. And you can see IWM's not close, SPY is not close, QQQ is not close. I mean, these are about as bullish of a pattern as you can get on their patterns. And remember, this is what this chart shows you is a visualization of the intraday chart here, where this would be the green line, that would be the red line. So when the green line's at 100, the high is over here on the very far right. When the red line's near 0, the low is way over here on the far left. And that's a couple more days, and that's going to be over here, and we're going to move it up. And remember, there's a gap over here. That's a pretty decent runaway gap on August the 14th. And you can see a few other gaps that still just haven't really filled. Like, for example, the one on the 19th. They haven't really filled yet. We've been filling all the rest of them since. So just kind of keep your eyes on that. And the other thing too that kind of stands out is the gap here between 470 and 431. We have about a 40-point gap, so near a 10% gap between the high and the low. We've really kind of stretched that rubber band out again. It's been a while, but since we've done that, that's a pretty decent stretch to the upside on this band. When you look at today's volume and trading range, you can see that the trading range obviously is very small, minimal, 2 points. The volume is also very minimal at 50 million shares trading hands. So when you put those numbers into context down here, 50 million is well below the average, and the average is already way low. Today's range, 2 points, well below the low end of the 52-week range. Well below, we already are well below 1%, making our way back down to extreme lows just like that. Kind of interesting too, that the highs and lows here that we have going on. This is, I'll just rechart this. This is the number of stocks at 20-day highs on the S&P 500. And you can see when we really kind of broke out here in the middle of October, we had a big surge, about 2 standard deviation. 38% of S&P 500 stocks were at 20-day highs. Since then, on this new peak that we've gotten here in early November, nowhere even close. We're at the 27%. We're at the 1 standard deviation. Another thing that I wanted to point out was how many stocks are above their 50-day moving average. Go out to a 2-year chart on this one. And again, this is a pretty decent breakout that we haven't seen for a while. We're above the mean, and we're higher than this. We have a higher high now. We're not as high as we were in April, mid-April there, but we do have a higher high than when we peaked there at the end of August, beginning of September. So very good sign from that perspective. Let me show you how many stocks. I showed you the S&P. The RSI is up above 70. So here's the percentage of stocks. Of the individual stocks that have an RSI up above 70, and you can see that if I go back to the 1 year, that we had a good surge there in October, and now this last little surge here in November is a lower peak, up above 13%. So the index itself is well above 70, but not a lot of the constituents have an RSI up above 70. So kind of interesting to see. In fact, it's a lower high point. So a lot of divergence is showing up, as we saw in some of the oscillators too, especially the CCI, and with the extremes on some of the others, like the MACD and like the RSI. Just kind of we see it already starting to be a limiting factor with today's smaller range, very small range, half of what already is a very low low daily range, average range, and then the very little volume, which is less than well below the average, which is already at 52-week lows practically. So we kind of see how the grind, that if we're going to stay bullish, the grind that we'll get with very small moves for the major indexes, with the different constituents kind of pushing us up one way, with different constituents having the big moves on an individual basis. One of the other limiting factors is the VIX, which you notice is continuing to actually move higher. We've had a couple of up days in the market on Friday, on really the last 3 days. Have all three been up days? Because remember, we're on this we're on an 8-day streak. Yet the VIX has been up the last 3 days too. So we have a 3-day streak where both the S&P 500 and volatility have both rallied to the upside. So that's not normal, and it kind of just goes to show that volatility is at an extreme low point and is unable to really break that 15 level. I mentioned that this was the 340th new high that we've gotten since this stretch started in 2013, when we finally got up above those 2008 highs or 2007 highs. We've had 340 new highs since then. That's more than the stretch in the 90s, where we had a bunch of new 52-week or new all-time highs year after year after year. So we've actually had more new all-time highs during this stretch that started in 2013 all the way through now. And the last 3 days again have also coincided with the VIX rising there, with the VIX being very low, very, very low relative to VIX 3M. So you can see the protection going on there, as well as the skew, which measures the volatility, the price of options that are way out of the money. You can see they're still very, very high, the price of those. So the market's still pricing in, or still hedging against, a big move to the downside and a long extended run of staying down, maybe not going down every single day, but staying down, with the VIX, the VIX 3M staying up as high as it is relative to the VIX, and the fact that the VIX can't get below 15. So just to kind of sum up, we have a strong bullish posture. There's lots of extremes. The divergence is showing up, and you can see you would expect that we'll kind of maintain bullishness until we get a catalyst that sparks more selling. But you can see the type of bullishness we'll get, right? Today was a good example of what we can expect to get tomorrow and the day after that, and going into next week. Just small grinding moves to the upside with very little volume, and then we'll kind of pick and choose which sectors. As you'll see today, energy and materials had a good move. Other sectors will have good runs, maybe tomorrow, and they'll just kind of take turns with correlations dropping when we're so bullish. We'll just have taken turns until we get more of a broader selling that takes over all of the sectors, and we get even more of an intermediate pullback than that, very, very light one that we saw here in September. So what do you think? Do you agree with that assessment? Do you disagree? Let me know in the comment section below, especially if you disagree. What charts or indicators are you looking at that would suggest to you why you're either a lot more bullish than I am, or why you're a lot more bearish than I am? Alright, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. You liked our video today, number one. Number two, you want us to do another video again tomorrow. It's a quick way to let us know you like our stuff. Of course, if you don't like our stuff, you don't have to click on anything. You also don't even have to watch if you don't like it. Also, comment down there. What did you get out of our videos today? What questions or comments do you have? Post those in the comment section below. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle at DavidSettle42. And join our Market Outlook Facebook group that we've created. Alright, if you're watching us here on our blog, over here on the right, we have some other things you can check out, including click on this icon right there that takes you to our Market Outlook live page. You can see I do these every Monday, Wednesday, and Friday at 3:30 Eastern Time right here on this page. You can also get to it by coming up here on the Market Outlook. Click on Market Outlook Live Trade Review. You can see all the old archives right here. This is where I review all the trades we've done in prior videos to see whether we should stay in them, get out of them, talk about why and how. We also put on today's trade idea before the market closed. So check that out there. You can also come over here, click see our upcoming classes we have. If you click view more, or if you come up to trading rooms to click on that link, that takes you to our calendar. You can see all of our upcoming classes as well as our previous recordings that we have. Come down to the bottom, hit this heart. It opens up a new page. Click on this like button right there. Also click this thumbs up icon, opens up another new tab, and hit that like button there as well. Again, the more you do that, it helps our content get out to all of our followers that follow us on these platforms based on how their algorithms work. It also benefits you because Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us right here while you're watching the video. All right, now let's take a look at what's driving the price action today. And you can see on the 3-month chart, commodities, we're kind of an outlier, and really equities kind of joined that party late, but then commodities peak and equities kept going up, and nothing else really has kind of followed suit. Everything else, in fact, bonds are up too since this low point that they've had, on October the 21st. Gold is up as well. So it's not, and commodities have been down, but IWM and QQQ have been very, very bullish. In fact, if you, including today, just go over the past week here, come to November, and we'll just go over for the last 5 sessions. Again, you can see just how strongly the S&P is up almost 2% in the last 5 trading days, but commodities are down. But look at gold and bonds are also up over 1.5% each. And the dollar's been up too. So kind of interesting that as risk on as we've been, it's the safe haven assets have not been kind of risk off. And today you can see the biggest winners with the weakness in the dollar was commodities, gold, and EEM. Small caps to a degree. Small caps started the day very strong, gave back a lot of their gains, about more than half of their gains by the end of the day. And you can see what was down at the bottom. Real estate stocks, bonds, all kinds of bonds were down. High yield corporate bonds, global bonds, emerging markets were down. Developed markets were down. The Qs ended up being negative on the day. So kind of interesting to see what your big winners and your big losers were. If you take a look at the market forecast here for the US dollar, you can see the pullback it's had. Now, granted, the near-term line, momentum line, is kind of really not making a move one way or the other. This is what it looks like on the Euro-US dollar. You can see that we've rallied up. We got that long lower shadow a couple of days ago. We've rallied up, and you can see now the near-term line is back into the bullish territory again. Very similar to coming off of that low point. This time we're a lot closer to the 30-day moving average. In fact, we have light green shading and a yellow line here. We're just barely above the moving average. The intermediate line still in bearish territory along with market sentiment. So we're not necessarily breaking out to any degree. When you look at the 2-line version of this chart, you can see again, we're well below the 200-day moving average, and we're actually pretty decently below the 50-day. And then yesterday, today here, because remember this candle just barely started here this evening, so it doesn't have a whole lot time yet. This candle for today actually closed at the 8-day moving average, so we're hardly bullish, but that long lower shadow, kind of out of the support level here, this 50% fib level, and then potentially closing above all these lines. Has some bullish ramifications for the euro, so bearishness for the dollar. So we'll kind of keep our eyes to see how long that goes on, because other safe haven assets like bonds, really broke out. They're kind of hitting some resistance, but well above the 50-day moving average, well above these previous highs. The 8 and 17 are rising, well above the 30. We had this kind of pullback to the 200-day moving average, but we bounced right off of that. And you can see gold kind of broke out too, and is holding that breakout today. So again, that's not your typical risk on patterns when you see gold and long-term bonds breaking out like they are. And then, like I said before, the US dollar still on this golden cross, and despite the pullback, still at their, at its 30, above its 30-day moving average, and the 8 and the 17-day moving averages. The 8 at least is above the 17-day with this positive MACD. So despite the pullback, you still have a pretty decently bullish intermediate trend for the dollar, as well as a breakout on bonds and a breakout on gold prices. So safety is very in demand right now, interestingly enough. When you take a look at the major global markets out here, we saw how bullish the S&P 500 is and how far above the moving average. That's not the case everywhere. You do have some cases like Italy way up above its moving average, France way up above its moving average, Canada is way up above, but a lot of other things you're still kind of coming off of lows. You're still in a bearish trend on Korea and Brazil. Some others like Japan and Germany, you're above the moving average, but just barely. So we're not quite strong. There's only a few pockets of very strong strength, as well as some weakness, whether it's weak relative strength, underperforming the S&P, or still some area major of the economy still in bearish trends right now. Let's take a look at how the sectors performed, and that's, like I said, we're kind of in the mode right now where different sectors take their different leads. Let's take a look at how things performed you can see that with the rise in commodities, it really benefited energy. And you can see lately XLY, especially because of Tesla, has taken off like a rocket. Let's just take a look at just today alone, because it was a kind of a bearish dollar day that we had. So here, let's go to November the 8th. And just look at today here. You can see materials and energy benefits the most from weakness in the dollar. But you can also see that we had financials, you had technology, you had healthcare, you had industrials, kind of a mixture of different areas of the market kind of all put together. And then down at the bottom, your staples, utilities, but also your discretionary. So consumer stocks in general, whether they were discretionary or staples, all really lagging behind. Utilities lagging behind. Again, a rise in yields is not very strong for utilities or communication services or real estate. They're very interest rate sensitive there. So if we continue to get a rise in yields, it pushes those down. But with bonds rising, yields falling, you wouldn't expect that to be the case. So this pattern today looks like yields actually rose. But when you look at the charts themselves, you can see that yields did bounce. The 10-year yield actually bounced up a little bit, even if the 30-year, the very long-term bonds, only had a very minor pullback. Remember, these are more economic growth sensitive, whereas TNX is more influenced by inflation expectations and by interest rate hike expectations, which actually rallied here today. When you look at the expectations that the Fed will raise interest rates, and it's kind of reflected by the 2-year yield is all the way up to 4.45 today on a yield basis. Let's see if it had 0.449, so almost 0.45 was the high today. When you look at that here in terms of our expectations for a rate hike by June, you can see that it ramped up a little bit, about 5 percentage points. So we're getting closer back up to that 60% mark, which again, the Fed is expected to end its tapering by June, and the market's starting to price in a rate hike as soon as they're done tapering there. So you can see that was kind of reflected more in a jump in the 10-year yield today, with the potential of this Harami pattern and a rise in the histogram than it was in the long term, where you did drop a little bit, but you're still holding that breakout that we had on Friday on those long-term bonds that span out double the 10-year time frame, 20 plus years, 20 to 30 years. All right, now let's take a look at our trade idea of the day, and I want to take a look at D.R. Horton, another home builder. Very strong move, kind of off the highs of the day today by the time we close. So the near term line didn't quite finish as high as it was. We were well into the above the 90th percentile, so we pulled back, but still in the upper reversal zone. And you can see the intermediate line, which was also above 80 earlier today too, is just slightly below it. But very strong move up above the moving average. Breakout move that we got with that long upper shadow, two long upper shadows here on this little rally, but we closed above both of them on Friday. So a good breakout move above some resistance in that regard, and then holding that so far here today. You can see from a long-term chart, you can see the new change after getting below the 200-day moving average or 40-week moving average. We have now gotten back above it with some good bullish candles here. The PPO is rising. You have positive. You have the Heikin-Yashi differential rising down there as well. When you look at the 3 green arrow chart, for DHI, you can see we've been kind of green to no shading the green, but we're back to green shading with 3 green arrows. When you look at the 2-line version of that chart there, you can see we are back up above the 50-day. The 8 and the 17-day have crossed above the 50-day. In fact, they're both crossing above the 200-day. And you can see where the point of control, you got a very strong support now at that 200-day moving average now that we're back up above it. Obviously, the 30-day has gotten below. We just barely got a little bit of a death cross, but it doesn't expect to last very long if your price and the 8 and 17-day moving average are already back above both the 50 and the 200. That will eventually start bringing the 50-day up with it. You can see the nice strong volume we've had today to help kind of solidify Friday's breakout move there. When you look at some of these other oscillators, again, you can see we are above 25 or below 20. Well below 20 in the negative indicator, rising. So as a result, we have a rising ADX. We have a good RSI, or well above 60. We're well above 100. Even got up to above 200. So a good kind of breakout move there. When you look at it from that perspective, looking at the Bollinger Bands, you can see we are up in the 94th percentile. So we're really pushing up against that upper band there. So that's a good sign too. Ichimoku trend cloud, you can see we are up above the cloud going into earnings tomorrow morning. This is why it's good to watch the market outlook live, because we'll have earnings on this stock before the market opens up tomorrow. Finally, so that was it. That was actually the last chart I wanted to show. So when you look at the trade, so what we decided to do there, especially with the earnings coming up, is look at doing a short put vertical spread. So we're going to come over here, sell the 38, so the 90 strike, buy the 87.5. Our trade actually didn't fill in. My trade didn't fill in before the market closed. Actually did. No, it looks like we got 70. No, it expired. So we didn't quite get that trade to fill in. So we'll see if it fills in tomorrow. How much of a change in price the earnings will impact that trade. If it's not a big impact here, you can see it from this perspective. If there's not a big impact, even if it pulls back, remember you got very strong support down at that $90 level. In fact, if you saw on that chart, the break even is on the chart for that bull put spread. It's sitting right at that point of control. So as long as we don't get too much of a move, especially to the upside, we can sell the $90 strike, buy the 87.5, depending upon where we get filled in. Again, the spread really widened out there going into earnings. It was a lot tighter before the market closed, but it got really widened out after the market closed with the earnings announcement coming up. So after the market opens up tomorrow, they will tighten back up again. And again, depending upon the market reaction and what kind of move we might get up or down, we'll take advantage of that and look for that bull put spread coming out of it tomorrow morning. All right, well, that wraps us up for today. You've heard from me now, and I want to hear from you. Use that link popping out in the top right corner of your screen that takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video down below. Have a great rest of your Monday night, everybody. Again, thank you for watching, and we'll see you all next time.